Now we'll do a demonstration of E8-10. This can be found on page 363 in your textbook or in the Chapter 8 practice problems in Connect. This problem deals with notes receivable. Remember that when we refer to notes, we really are talking about promissory notes, a written promise to pay a company or individual principal plus interest at a future date. There are 3 reasons why your company might accept a promissory note. In other words, a note receivable. The company might be loaning money to another business or an employee, in which case we would debit note receivable and credit cash. The company might be selling an expensive item, for which customers may need an extended payment period, or perhaps the amount is beyond their credit limit. So we would debit notes receivable and credit sales. Or finally, a company may convert an existing accounts receivable to a notes receivable in order to allow for an extended payment period. In that case, we would debit notes receivable and credit accounts receivable. There are 4 key events in recording notes receivable. The first is when the note is received, when we establish the notes receivable. The second is when we accrue interest before preparing financial statements to record interest earned. And the third and fourth situations occur simultaneously, and that's when we receive interest and principal at maturity date, the day that the note is due. In problem E8-10, we're told the following transactions took place for Smart Solutions Incorporated. On July 1st, 2014, Smart Solutions loaned $70,000 to an employee of the company and received back a 1-year 10% note. Okay, so we are giving the employee $70,000. They're giving us a note receivable. When we receive a note, we debit the asset note receivable. And what are we giving the employee? Cash. So we'll credit cash to record that loan. Now we don't record any interest yet. Interest only accrues over time. So in our next transaction, we have to accrue interest on the note. From July 1st to December 31st, 6 months have passed. So we have earned 6 months worth of interest. We won't be receiving it because with short-term notes, notes that are a year or less in length, principal and interest are received at maturity. Let's figure out how much we've earned so far. Let's multiply the principal, $70,000, times the interest rate, 10%, times the time factor, 6 months divided by 12. The reason why we do this is that this interest rate of 10% reflects an annual rate. If we just multiply 70,000 times 10% and get 7,000, that would be interest for an entire year. We only want to record interest for 6 months, half a year. So we multiply by 6/12. If we wanted to calculate interest for 3 months, we'd multiply by 3/12. For 1 month, we'd multiply by 1/12. So we always have to multiply by a time factor. If your note, however, is in terms of days, for example, a 30-day note or a 60-day note or a 90-day note, we would simply multiply by the number of days that passed divided by 365 instead of divided by 12. So if we multiply 70,000 times 10% times 6/12, we would get $3,500 in interest earned. So we're going to debit interest receivable because we're not going to receive payment until the due date of the note, sometimes called the maturity date. And we're going to credit interest revenue because we've earned it, because they've had access and use of our cash over time, over 6 months. Items C and D occur on the same day here, July 1st. We're receiving both interest and principal. So this is the maturity date or payment date. We will expect to receive cash. How much? Well, it depends. We've got to first calculate how much interest have we earned since the last time we recorded interest. Well, that was December 31st. This is July 1st. So 6 full months have passed. Again, you can multiply out 70,000 times 10% interest rate times 6 months divided by 12 to give you $3,500. That's how much interest has been earned since December 31st to July 1st. So we'll credit interest revenue. I'm sorry about my typing. Plus, we are going to be receiving this $3,500 that we earned from last July 1st through December 31st. So we're going to be crediting the receivable for $3,500. We can add these two up to see how much cash we received, or a total of $7,000 in interest. We can also calculate that by using our interest formula. We can multiply 70,000 times 10%. I apologize, I had a period there and I meant to put a multiplication sign. Times how much time has passed for the entire length of the note. It went from July 1st, 2014, when the note was made, until July 1st, 2015. That's a full year. So we can multiply by 12 divided by 12, or the number 1, so that would be 7,000 for a full year's worth of interest. We can use that calculation to double check the amount that we use here. So you will receive $7,000 worth of cash for the interest payment. When we receive our principal, it will simply be a reversal of this entry. On July 1st, 2014, we gave our employee $75,000. He or she gave us a note. Now, he or she is going to give us $70,000 in cash, and we're going to cancel the receivable, the note receivable. We're going to release them from their obligation to pay us. And we're done with E8-10. Now you can try your homework. Have a good day.